Right, evening, guys. Slight technical issues here, so just bear with me for a moment. I have no idea why I've tried this for the last 10 minutes, try to get on. So hopefully you guys can hear me. Please let me know if you can. Happy New Year, by the way. I still have loss of audio on my side right here, so I just need to try and fix that. Give me 1 minute to try and do that, mate. To put this back up. All right, so fingers crossed this now works. Please let me know if you can hear me okay. Fingers crossed you can. Let's me just have a look at the chat quickly. All right, okay, here. Marky, how are you? You can hear me. We can hear you. Happy New Year. Happy New Year, guys. Welcome to this first live Q&A of the year. How was everybody's Christmas, by the way? I had a very, very nice break over the Christmas period doing nothing, which is not normal for me, to be honest, but it was nice. So now that we're in the new year, this is the first live Q&A. There's a lot going on for me personally through the back end of January into February. So I just want to talk a little bit about what's going to happen on the channel and stuff like that. So some of the videos will be kind of like run and gun type of style, because I'm going to be out and about quite a bit on a project. So some of it won't be in here. A lot of it will just be out and about, hotel rooms, that kind of stuff. But hopefully we'll give a little bit of variety and stuff to the feel of the channel. It will kind of get back to normal in about March or so, if all things go well, that is. So obviously, pandemic and Omicron could potentially put a spanner in the works for all of that. But anyway, this is a live Q&A. So as always, I will try to answer any questions that you guys have. By the way, actually, and maybe I do need to do a little bit of a shameless plug, and I will do a shameless plug on this, by the way. And this is just testament to the fact that I am so behind, because I was not expecting me to have all of these issues with starting the stream this evening. Let me just get rid of that very quickly. I do want to share my screen with you, because one of the things that I wanted to do at the turn of this year was actually produce maybe like a newsletter. And then the idea of the newsletter went from an email template newsletter into something much, 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 much bigger than that. So it's now a digital magazine. So what I want to do is just show you the magazine very quickly so that you can see what it is that we're pushing out. It's going to go out tomorrow at 3 p.m. So if you are not subscribed to this already, I would encourage you to do that. All you need to do is go to conversationofmoney.com, and on the top banner, you should be able to leave your email address to subscribe to it. But essentially, it is a magazine called the Convo, essentially. So conversation, short term, the Convo. And it's basically designed to be as interactive as we possibly can have it, really, to be fair. So it is a flip magazine. I'm just going to walk you. Let me just make this a little bit bigger, actually. That window needs to be bigger. Right, let me just flip through it. So essentially, we're going to have lots of stories in here, essentially. We're going to have, sort of New Year's resolution, setting goals. We're going to have a little bit around some research that we're doing around savings at the moment. 7 times salary mortgages. I did a video on that on Tuesday. This is going to give you the lowdown in written form. That's the stock market outlook for 2022, which is also going to be included. There's a relevant video to watch. Then we've got something on here around managing multiple investment accounts. Actually, I have a video for that coming on Tuesday. It's very, very, very cool. I've been using it for the last maybe 2 to 3 months, just being able to see all of my accounts in one location without having to log into, Stake, Free Trade, eToro, Hargreaves Lansdowne, Vanguard, and having it all in one place is phenomenal. Plus, they do a lot of other stuff as well. We have a little bit of a a segment called Simplify It, where we basically try to break down financial jargon so you can actually improve your financial vocabulary every issue. We've got something around crypto. So we're going to review 2021. We're also going to give you a look at 2022 top five. Then this one right here is all about what have the pros been buying. So how did the pros actually invest in Q3 off the backdrop of inflation? What companies were they buying? We're going to give insights to that and provide a few thoughts as well. And then there's some feedback which we'd like you on here. But this magazine will be a monthly magazine at the very, very least. It might be bi-monthly. I'm just very, very conscious that it's just me still doing this. So if you've not subscribed to that, it's going to be a really, really good read. I strongly encourage you to go do that. It's conversationofmoney.com. The first bit you'll see at the banner at the top will basically be how you subscribe. That is going to go out tomorrow afternoon. So if you're not subscribed and you want to get a copy of that, by all means, head over to the website to subscribe. Right, okay. Let's have a look. There are no questions in here at the minute, which is a surprise to me. How is everybody getting on their investment journey? I know that crypto is a little bit down at the moment. Actually, Bitcoin is kicking my butt a little bit. But obviously it's crypto, so volatility and all that it comes with the territory, as you can imagine. But we're a long way from the highs of 66,000. When was that? It feels like an eternity now, but it was only in November or so that we had 66,000 a coin. It's interesting because Ralik, who's been on here, who actually contributes to the magazine, he gives his views on what's actually going to happen with Bitcoin and cryptocurrencies as a whole in 2022. There is a lot of speculation. Some people are actually quite bullish on it still. There are noises that the Americans, so the SEC, is really going to start embracing crypto in 2022. And if they do, that will open the floodgates to regulation. And whilst regulation is, frowned upon, I think it will be a good thing in the long term, especially when we start talking about the spot price ETFs, which are the ones that will really open the floodgates to institutions being able to invest in cryptocurrencies. But yeah, Ranick gives his top 5 cryptocurrencies that he's going to be investing in and that are on his radar this year in the article as well. So I need to have a little chat with him as well. I was hoping to get him on here tonight, but I know he did a live on his channel earlier today. So let's actually have went to Wolves and played a couple sports. Nice. We've got, okay, there's a question on here from Timothy. Where do you think crypto is going to go? Lots of talk of market correction. Look, okay, so on the market correction side of things, crypto, it looked at one point as though crypto was going to diverge from the market. So in other words, if the market kind of like crashed, it looked at one point as though crypto would kind of be the alternative investment that people would actually flock to. I think they've come in line a little bit now. There is a lot of fears in the States. I mean, there are mixed reviews, and I'd kind of say this in the market outlook. Some of the biggest threats at the moment to invest in next year, not just in the crypto space, but certainly in the stock market, is interest rates, what the Bank of England and the Fed are going to do around interest rates. But bigger in the United States is the whole issue of what's going to happen with the tapering. So I think they did confirm back end of last year that they are going to start tapering at a rate of 30 billion a month, which will mean that by the time we get to Q2, the 120 billion that they've been pumping into the markets to keep things buoyant, that will effectively come to an end. And that is problematic, particularly if you have sharp interest rate rises That's going to mean that the markets are going to get a little bit spooked potentially. And then obviously we can't ignore Omicron and what's going on there. If there are any further disruptions in terms of lockdowns, partial lockdowns, so on and so forth, those I think are the biggest threats this year to the marks and to the markets. And I didn't really catch. I can't remember whether they actually announced last week the employment numbers in the States, but a lot of people are going to be watching the employment numbers in the States purely because if there is confidence within the United States that the employment rates are increasing, so people are getting back to work, that is a good indication as to a recovery in the economy. And so I think there will be lots of people monitoring what's going to happen there. There is an element of confidence that we think that the employment numbers will be okay, but we'll have to see what happens moving forward and how they actually deal with that. There is this old saying, right, that if America sneezes, the whole world catches the cold because they are the largest market in the world. So it's going to be interesting to see what happens. But on the crypto side, I was hoping that it wouldn't correlate with the markets, but it feels like it is correlating with the markets, and it feels like it will correlate with the markets moving forward, which is unfortunate, really. But hopefully, sorry, I just want to get rid of this quickly. What's going on? There we go, and get my other screen up. So yeah, that's generally what I think of the markets. I think, look, we always have to expect that there's going to be volatility, right? That's just the nature of the game. And so if you are investing in the three ways that you can invest, i.e., buying individual stocks, that you obviously need to be sure of your buys and the research that you're doing. You need to have conviction in that research. If you're invested in index funds, ETFs, you're going to get a little bit of diversification in there, but it will be volatile, not as volatile as if you bought individual stocks. And and it's separate if you're invested in a lump sum, you just need to be willing to know that you might see massive growth in one period of time, but it might also fall. And if you're buying investments on a monthly basis, so you're pound cost averaging, then happy days, because you can just ride the wave of the markets. And yes, we might still see the markets fall, but it comes with the territory. It's just, expect that it is going to be volatile and just try and feed that into your plans. I know it's very, very difficult if you are in a position where you're trying to, plan for a house purchase. Then it becomes really difficult to manage that risk. And I've done some coaching this week, and I've just said to people that, maybe the strategy that you want to do if you're, investing to save for a house is be strategic with how you allocate the cash that you're going to be putting into these investments. So maybe take a little bit less risk with, the house deposit, because ultimately the house is the prize, and just being pragmatic around the risk that you're willing to take with it as well. So, yeah. Right, this is a good one on here. So, my question is, how do you know if a company is undervalued or overvalued? There is a calculation for it. I mean, the simple way for you to be able to know some of this stuff, I mean, there's a tool called Simply Wall Street. If you use Simply Wall Street, they do all the calculations on your behalf. So that will tell you whether, from the equation point of view, looking at their share price versus all of their turnover and all of the financial metrics, whether they're overvalued or undervalued. With that being said, though, you know, you should pay attention to some of those metrics and whether something is overvalued or undervalued. But I'll give you a prime example of a company that, for the longest time, has always been deemed to be overvalued, but is still going great guns and has continued to perform. Last year, it started this year off really, really well, and that's Tesla, right? People have always said Tesla is way, 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 way overvalued. And if you go into it trying to pick companies purely on whether they're undervalued or overvalued, yes, it's a piece of it's part of the research that you need to do, but it needs to form part of a wider opinion that you have about a company. It shouldn't be the only metric that you're looking for. So, for example, with companies like Tesla, the reason why they will say it's overvalued is because a lot of the tech and the future performance of the company is priced in right now. Although it feels as though the stock is continually defying that narrative and defying that logic, because even with a 5-to-1 stock split, when was that, last year or year before? it's still going great guns. If it hadn't done that stock split, it would have hit most of the targets that it had in place by a lot of the analysts that are out there. So it is a really, really good metric for you to have a look at. But I think fundamentally, if you're doing the research, that particular point of whether it's undervalued or overvalued should be backed up by what do they do? What are their financials like? Are their revenues growing? Do they have a lot of cash? If they're a dividend paying company, are they paying dividends? Do they have any strategic advantage in this sector or in the market that they're operating in? Is there any competition that is a threat to the business in the immediate or the medium to short term? Those are really, really the key questions that you should be asking. Undervalued, overvalued is part of that equation, but it's not the end all be all of it. But if you're using apps like or websites like Simply Wall Street, without you having to do the calculation yourself with the share price and all of that data, it will basically do all of that analysis for you straight off the bat. So yeah. Mark is asking, got my investments with Vanguard for the past year, have a mixture of VVRL and S&P, etc. What's the return? Is averaging just under 10%. Any views? Well, the markets are the markets, mate. I mean, the I said this some the other week, right? If you go onto Vanguard right now, you try and average some of the performance that they're showing on their website, you might think that actually you're underperforming, but it really depends on your point of entry. So when did you actually get into the market? What was going on? Did you see kind of like a trail off at the point of entry? Or have you gone in, you've seen growth, but the markets have trailed off? If the markets have trailed off, then you're going to see a reduced amount of performance. Having said that, though, if you're just under 10%, you're like 9-ish percent, that's still a pretty decent return. Um, it is still a decent return. Remember, if you look back over the market history and stuff like that, S&P has probably done anywhere between 10 and 12. So if you're just under 10, you're not too far behind its actual benchmark, even though you might look at some of the Vanguard uh, graphs and data on performance and see that, they're 20 odd percent return. Again, timing really matters when you got in, so on and so forth. So bearing in mind the last part, the Q4 has been a bit bumpy, and there's been a lot going on with the whole inflation fears and stuff. So I would say that's still a pretty decent return. The question is, what's going to happen moving forward? We don't know, but just expect a little bit of volatility. I would imagine within the S&P 500, you'll still have a little bit of protection in there, the top 500 companies. So in terms of strength and stability, they're as good as you're going to get. I think you meant the VWRL there. That's the global one, isn't it? So you're still going to have global diversification. The big threat there is going to be, pandemic, travel sectors, that kind of stuff. Who's going into lockdown, particularly if you're in the Eurozone. But there were a lot of analysts, and I say this in the market overview, there are a lot of analysts that believe that the Omicron variant isn't going to cause too much of an issue this year in the Eurozone. You could debate that because of the stance that some of these governments have taken, like full lockdowns and mandating vaccines. We don't know what impact that's going to have ultimately on economic numbers. I mean, we've seen some countries revolt and kick off and say, look, we don't want to be dictated to. So they could be right, they could be wrong, but that's the general sense of the feeling. But if you're doing just under 10%, given everything that's happened, it's not bad. Okay, there was a question on here. When Dodal is launched, AJ Bell app, can you do a review, please? Yeah, I can. Yeah, I didn't know they even had one coming. Let me just. Have they got a landing page for that? Let me have a look. Dodal. Okay. AJ expensive, so I'll be interested to see. I'll be very, very interested to see what their charging structure would be, because it's an app, and I would imagine they're going to be offering kind of like passive ETFs and passive strategies in here. They might even include individual stocks, maybe, because they've got the ability and the scope to be able to do that. I'll be interested to know what the charging structure will be. This is interesting. You know what? It's so amazing to see some of these traditional companies now like turn tail and actually, because I'm looking at their website right now. It says here, be one of the first to take a look at Dodal, the new no nonsense investment app that guides you through the investment process with no fuss and no jargon. Like, the only reason why they've gone down this route is because they can see the success of all the new ones that have come along. Where for years, and to be honest, they should be credited for actually being like, oh, hang on a second, we need to do something different. But for years, they've had their cake and eat it. They're one of the providers that have been very, very expensive, and they focus on a certain demographic. And now what they're trying to do is they're trying to capture another demographic, which is smart business sense. But it's interesting to see that they've actually made this move. I'll be very, very interested to see whether it will be a success or not. And some of the common fears that they have, because I had this one of the discretionary fund managers that I had, and they refused to do it for years and years and years. And when they did finally get around to doing it, one of their big fears was that if they launched an app where everything was low cost, low fee, and it gave more control to the consumers, they had a big fear that it was going to cannibalize their existing book of clients who are paying them fat fees to look after their investments. So I wonder how AJ Bell are going to handle that little uh, paradigm internally and in their messaging and within the offering itself. So, are they going to limit the kind of things that you can invest in? What exactly is that offering going to be? It's going to be interesting. I will do a review in it because I'll be interested to see what stance they basically take and whether they actually give you full access, like maybe some of the competitors in this space. And look, this is very, very interesting. Thanks for that, Martin, because I didn't know that they were doing this. This is really, really interesting. I will review it when it launches. I think I might actually put my name down for the wait list. There you go. I'm on the wait list now, so I'm sure I'll get updates on it too. Okay, this is a Vanguard question. The VUAG reinvested dividends or the VUSA paid dividends? What is the tax relief on pensions? How does in, how does in, how does increasing pension contributions reduce tax? Look, I can't tell you whether you should go with the reinvested dividends or the paid dividends. I can't do that, mate. I don't know your situation. So the main thing you need to bear in mind is if it's reinvested if it's the dividends are reinvested, it's going to help you with the compounding effect. I'm not aware of the VUSA paying you dividends out so it hits your account and stays in cash. I'm pretty sure it's reinvested as well. They reinvest the whole thing, as far as I'm aware, unless I'm wrong. I could be wrong. On the second question, what is the tax relief on pension? It's 25% on your contributions. And how does increase in pension contributions reduce tax? Well, it means, well, with pension contributions, essentially, you are getting the tax relief. So you're getting 25% top up on your pension contributions. So that's how you're reducing the tax. Well, technically reducing the tax. You're getting tax relief essentially, unless you do something like salary sacrifice. Salary sacrifice can actually help you reduce the tax because it will get taken out before you pay tax on your wages. So a lot of people, if they're in the brackets where they're earning, 100 plus, they might do a salary sacrifice because it will come up before you start paying tax. And that is always a good thing to do. But the downside to that is the fact that if you if you do a salary sacrifice and then you pay into a pension, you can't access it until you're 55 under the current legislation. Cheers for that, mate. You like the content, can't stay for long, but going to give the stream a like. Thank you very much. If you've not liked the stream already, by all means, please do that for me. That would be amazing. Thank you very much. I think we've got 20 on there at the moment. I know I'm a little bit behind on some of the comments and stuff, so I will catch up. I promise. And by the way, you can always watch this on replay because it will be saved as well. Gina, question. Let's have a look at this. I'm looking to invest for the first time, short term and long term. Any suggestions where to start? Right. So first and foremost, how do you want to invest? Okay, that's the first question, and this is going to give me the opportunity to basically illustrate what I mean when I say this. So bear with me because this is really, really important, because a lot of the time people, they want to invest, but they don't really know how they're going to start investing. And that's the very, very first question that you have to kind of be able to answer for yourself. So essentially, let's have a look at it. There are two main ways in which you can actually invest, technically speaking. This is true whether you are investing a lump sum or whether you're investing on a monthly basis. So the most popular one, or the most sexy one at this point in time, the most sexy one at this point in time is if you're using an app like, for example, Trading 212, I don't know, Free Trade, eToro, Stake, and that is if you're going to be buying individual stocks, right? So you like the look of, Tesla, or you like the look of Google, which is Alphabet, right? You like the look of these companies. You might have a look at Microsoft and companies like that, right? You want to go and buy these companies specifically. Okay, so that's buying individual stocks. That's the first way you can actually start investing. Now, if you're going to do this specific route to invest in, so this one right here, then you need to do a little bit more work in terms of the research that it takes for you to understand what you're buying. Because if you go and buy Tesla, guess what? Elon could go on, I don't know, Joe Rogan's podcast, smoke a spliff, and then the share price of Tesla goes from, $1,200 to $900 or overnight. If you put all your money in that, you're going to have that 300-point drop. Well, not 300, but 300-point drop, and that's going to lose you money. This specific strategy is more high risk, because unless you pick multiple accounts, you're not going to have diversification, and you have to be really, really confident in the companies that you're actually choosing. Now, the second route that you have is the most popular one, and the one that I do a little bit of both of this, but this is my core, my go-to, is you can start buying index funds and ETFs. Now, if you're buying index funds and ETFs, essentially what you're doing is you're probably going to be buying anywhere between 100 to 2,000 companies all in one go. Okay? This one means less risk, less volatility, because you're buying a basket of companies. You're not putting all of your egg in, a handful of companies like you are up here. Here, you're essentially buying a basket. So it's eggs in one basket. Imagine you have a basket and you've got one egg. If you drop that basket, you're done, because you're likely going to break that one egg you have. Whereas if you have a basket with 500 companies in it, like the S&P 500, well, if you drop that basket or the markets don't perform well, if, I don't know, 200 don't do well, 300 could. Means you're going to diversify your risk, reduce your risk a little bit. This is, for me, one of the best ways to go about investing, for sure, without question, for me. Now, if you want to do that, there are lots of ways that you can actually go about investing. Vanguard is probably a good place for you to start. You've got Hargreaves Lansdown. You've got the likes of Invest Engine. That's if you want to pick them yourself with no guidance, right? So this is DIY. If you want it to be done for you, then you've got the likes of Wealthify. You've got the likes of Money Farm. And you've got the likes of Moneybox. Got the likes of Plum. Okay? So those are just a few places where you could actually start if you wanted to invest. The question is, do you want to go here or here? And if you are here, do you want to do it yourself, or do you want someone to do it for you? That's the main question. So, Gina, if you understand and that's made sense to you, maybe just a few questions to ask yourself. Once you know the answers to that, everything else will become a little bit easier, because then you would have to just decide, number one, who the provider is that you want to use, select the appropriate one. And if you do need help, just literally ask for help. Because at the end of the day, I've done quite a few coaching calls already this year where people are like, I've watched so much on YouTube, but now they've got to the point where they're just really, really confused and they're not really too sure whether all the information that they've been getting, whether they can decipher all of that information in order to make the right decision for them. So if you do need help, I do coaching. You can always reach out to me there. But like I said, there's lots of videos on the channel which you should be able to help, but you need the answer to those questions in order to know where to actually begin. Carl. Hey Pete, if I had ISA stocks and shares with Money Farm, can I open an account with Vanguard? And target return funds for Vanguard is a good option for pension. Okay, so if you have an ISA account with Money Farm, if you're still within the same tax year, you cannot go and open another one with Vanguard, because you're going to be breaching the ISA contribution rules. Really, really, really important point, guys. So because the tax year basically starts April the 6th. Let me just illustrate this for you as well, actually, so you can see what I'm going to be talking about. Okay, so for your ISAs, the tax year is April the 6th to April the 5th. And that's every single year. So it's like a cycle, right? You get to this point, then it will start all over again. So it doesn't matter whether you're in 2020, 2022, 2021. April the 5th is the beginning of a new tax year. That is the end. So if during this current tax year you've paid into an ISA, you cannot go and pay more money into a Vanguard ISA. You're not allowed to do so. The only thing you could do is, if you've got money with Money Farm and you're looking at Vanguard right now, and you think Vanguard's a really, really good option, the only thing you can do is you can do a transfer between the two. But in order to do that, you have to get Vanguard to ask Money Farm to do the transfer. Do not close this. Don't do it. You never ever want to close your ISA account and then try to move it to another company, because then you're going to be in danger that if you have been lucky enough to be able to build up quite a bit into your ISAs, you potentially won't be able to pay in the full amount into the new place that you want to go to. So if you like Vanguard and you want to use Vanguard, essentially what you have to do is ask Vanguard to do a transfer or request a transfer from Money Farm over to them. That is the best way of going about it. But yeah, you can't contribute to both at the same time. You're breaching the rules if you actually do that. The second part of your question there was, are target retirement funds with Vanguard good for pensions? Yes, they are. I mean, they are targeted for a specific time in the future. They're low cost. They will taper, so they will basically reduce the level of risk that they're taking the closer you get to your retirement date. But they are they are good options for you. I would probably argue that if you do want to have a look at opening a pension specifically, maybe it's worthwhile shopping around and having a look at all of the options for you, just to make sure that you get something that you can optimize your investment strategy in, to ensure that you have the largest amount available. But yeah, the target retirement funds are very, very good funds with Vanguard. Timothy, I've got a lot of money invested in stocks. Is this a good theory with inflation rising as growth stocks are losing their appeal? Yes. I mean, look. Sorry, I'm just reading your question again. Invested in sin stocks. I mean, look, this is where having a diversified portfolio is so important, right? I mean, if you're watching YouTubers just talking about 10x, 5x, 100x stocks, which are typically growth stocks, times like this are horrible, purely because, and I mentioned this in a video just before the Christmas break, right? What kind of stocks should you be looking for in periods of high inflation? You want to be looking for companies that have the ability to be able to pass on cost to their customers. So if you think about what happens in inflationary periods, right? Prices basically go up. So your energy costs, the cost of purchasing food, the cost of just general things around us, they all increase. That's the point of inflation, right? You start to lose your purchasing power unless you're earning more money, earning more money now because you can't get anything in interest rates. Unless you're earning more money, you're going to fall victim to inflation. So if you really think about it from a logical point of view, who are the companies that are going to do well in times of inflation? They're going to be companies that everybody needs. Energy companies, right? Energy companies can very, very easily pass on the cost. That's what they're trying to do now. I mean, the price cap is going to be removed. I think it's in April. So just wait and see how much energy prices go up once that cap is under the period of time where it's gone. Those prices are going to go crazy. Now that's bad if you're British Gas or a British Gas customer, but actually it's very, very good if you're a British Gas investor. If you're a shareholder in British Gas, it's great because they're taking on additional costs and they're passing it on to consumers. And at the end of the day, guess what? We need electric, we need gas, we need to heat our homes, and we need our electricity. So what are you going to do about it? The same thing applies if you are in, for example, Tesco's, Sainsbury's. If you're in the food industry, guess what? People have got to eat. So these companies will always do very, very well. People have got to eat, people have got to drink, people need necessities. So really, value companies are the ones that will do very, very well in inflation. And I talk about diversification at the top of this because if you're holding a portfolio where it's only just growth stocks, yeah, right, low inflationary periods, you're going to be absolutely sweet. But in times when it gets bumpy, you have no hedge. And that's the whole point of investing, right? To spread your risk. So you've got some money in a pool that is going to give you high growth, like in growth stocks and tech, for example. But you've also got the core companies that will always just trundle along and do really, really well as part of your portfolio. So yeah, I mean, look, value stocks at the moment, it's interesting to see what Ray Dalio actually bought in Q3. And I mentioned this in the magazine. His buys in Q3, there were a lot of value companies in there. He did some pharmaceuticals as well, but the majority of what he bought were value companies, so companies that actually, regardless of what happened, you need them. You're not going to stop buying their services and stop buying their things. You're not going to stop using their services. So yeah, you need to have a hedged approach. You need to have a balanced portfolio with diversification built into it. Food Dweller, how you doing? Let's have a look at this. Happy New Year, P and everyone. My question is, if you have, say, 30K, is it better to use it to buy a house or invest in index funds? Which one is the best option? Well, how buying a house for what purpose? What, to live in? To live in or to rent? Because that's the question, right? Because they're two different things. I mean, look, you've got the property market, which can be volatile and might be impacted by obviously what's going on, but it's still a physical asset, right? So you're going to have market fluctuations, but it's a physical asset. And with housing specifically, especially if it's like an investment property, you've got the whole supply versus demand equation, right? We still have too fewer homes for the amount of people who want these homes. So that equation right there should tell you that, well, people will always, in the property side of things, they should be able to sell their home for more than what they actually bought it for because of that equation. And that is the property market is predicated on that equation, right? So if you're buying a home either as an investment proposition, well, there are a number of things that you need to consider in there: location, rental yield, what rent you're going to get from it, that kind of stuff. Then the long-term prospects, and then you've got the mortgage and all that kind of stuff that you need to factor in, and costs, right? Whereas if you're going to go and buy index funds and ETFs and all those kind of instruments, well, you've got way more uh, economic factors that could basically impact the value of your investment. I mean, look, inflation, tapering, interest rates, pandemic, coronavirus. We're still talking about coronavirus, Brexit, which has gone underneath the radar. The amount of time it's going to take for these stocks to recover. It swings and roundabouts. It really depends on what your goals are. Um, with housing, you can't just sell it. So you better be sure that you're going to hold that for a long time, and you don't need to be able to release equity from it. It swings and roundabouts. They're two different kettles of fish. They have their pros and their cons. Um, I guess if you're able to pick up a property for cheap, if you've got 30K, I mean, you've got tenant risk if you're going to do it as a rental as well. So you've got those issues as well. You've got to pay, obviously, if you own your already one home, stamp duty, the cost, all those kind of things. But it really depends on what your goals are, mate. To be fair, I can't say you should do one over the other. Obviously, I'm a stock market guy, and I like the markets because of the liquidity, and it can be very, very easy. But we are heading for a turbulent time with the market, so you have to look at all options that are available to you. Carly, what's going on? Happy New Year to you. How's it going? We've not spoken for a while. We should get together again in the Discord. I was thinking about this the other day because Lynn's messaged in, had a meeting with Hannah this week, and it's like, yeah, I miss you guys. Trying to have a chat with you guys. We should try and organise something in the Discord group just to have a little get together on a Sunday or a Saturday on Zoom or something. Hope you're well though, Carly. You just had the dividends. Did it pay into your cash account or was it reinvested? Or is it just the transaction of dividend payments? Because remember, the VUSA it's the S&P 500. So some of those companies actually pay dividends, but did it pay into your cash account, so not reinvested, or was it just the transaction that you saw that dividends was paid? Let's have a look and see what we've got. 1 second, guys. Yeah. I do like this. I like this a lot. This is a very, very important question indeed. It is a very, very important question. Listen, Spud, it was phenomenal. It was absolutely phenomenal. It lived up to the hype. Let's put it that way. And yeah, I've seen it. I've seen it twice now. It was amazing, man. It was amazing. It really, really was. It lived up to all expectations. And yeah, look, Marvel keep doing this, and it's like, how are they going to top it? Like you watched like Infinity War, right? You're thinking an Endgame. Like, what are they going to do to top this? Then they go and do this, and it's like, okay, so what? How are you going to top this one now? It's very, very hard to see. But hey, it's Marvel. It's Kevin Feige. Listen, if you're not invested in properties like Disney right now, then you're missing an absolute trick because these guys are making money hands over fists. And yes, they've obviously had a bit of an impact with obviously the pandemic, but they've diversified their portfolio with Disney Plus. I mean, the Disney Plus numbers have been absolutely nuts. They've not taken a lot of money in the box office with people like with films like Black Widow and stuff, and they could have done better on Shang-Chi. But the revenue they've got through Disney Plus, which they don't have to share with movie theaters, is huge. And that's the reason why someone like, Scarlett Johansson tries to sue them, because she feels hard done by because she's got royalties on the back end. And unfortunately, Disney Plus wasn't built into those royalty payments. They've sorted it now, but Disney's a really hot property right now. They've got the book of Boba Fett on streaming at the moment. I've not watched it just yet. I need to catch up on that. But Spider-Man 3 was amazing. It was so good to see Toby and Andrew on the same screen. It's just like, mate, it's just nuts. I could get really excited about this. I'm a huge, huge Marvel fan, so I'm, I'm going to try to put a sock at it right there. Hi, Pete. I've got a work pension paying 6% and my employer's paying 13. Wow, dude. Wow. 13%. I have a Vanguard pension. Would it make sense for me to actually increase my contributions with my work rather than my Vanguard? Dude, 13%. That is amazing. Wow. Listen, before you do anything, before you start looking at contributing into the Vanguard pension, They may not do this because 13% is pretty high for a company. I don't know that many businesses that are paying 13% for pension contributions for their employees. So you may be in like a really good role or at a senior level or something, but 13% is incredible. But before you go and pay into Vanguard as an option, what I would probably suggest, and they may not do this, is in your workplace, ask if they have any further matching to offer. Because if they do, then you want to take advantage of the free money. With 13%, I'll be very, very surprised if they do. Because that is phenomenal. 13% is just monster. It's monstrous. But if they do have any matching, that would be great. And the question will be, but to match it under normal equations, you would have to go up to 13. So I don't know what your situation is. The other thing to ask would be how much the fees are within the workplace pension. Then again, you're talking Vanguard, and Vanguard are some of the cheapest on the market. But it's worthwhile asking this question anyway, just in case there is some other perk that they will offer you in the workplace. But 13% is just amazing. Who do you work for, mate? That's unheard of. I mean, I know of some financial services companies that do really, really well on contributions. I think the highest I've ever had was like 10%. I've never had 13%. That's incredible. It's really, really good. But yeah, I mean, ask those questions. Vanguard's very, very cheap. There is a cap on how much administrators can charge on workplace schemes. Um, I'll be surprised if it is lower than 1%, lower than the Vanguard fees. But it's worthwhile asking those questions just to see. But if the answers to those are no, then yeah, just pay more into the Vanguard ones and build it from there. But you probably want to get a good sight of what the actual scheme actually has, just to make sure that there aren't any perks that you're potentially missing out on if you did pay into somewhere else instead. Hi again, Pete. Would you look to increase pension contributions via a salary sacrifice scheme, or would you invest the spare cash yourself? It depends on whether you want access to it, mate. Remember, if you do salary sacrifice into a pension, you're going to be bound by those pension rules, so you can't access it until you're 55. If you're close to 55, then maybe it's a different conversation. But if you're a long way from 55, I would argue that maybe you might need access to those funds at some point in the near future. If that is the case, then it will be worthwhile putting it into, I don't know, something else. But then again, where do you put it? I mean, you could put it into things like ISAs. Use your whole £20,000 allowance. It's tax free. Easy. You'll be able to access it before 55. It really depends on whether whether you think you'll need access to the money in the medium to short term, whether you're just happy for it to be locked into a pension to build for that future. And it depends on how close you are to that. But yeah, I can't give you a definitive answer on that because I don't know more about your situation, Jeff. So hope that helps, though. I'm good, thanks, Joshua. Really, really good. Ginger's saying there, thanks. Index fund seems good, seems what I'm looking for. In that case, Gina, what you want to do is you want to start looking at the likes of Vanguard, Hargreaves, Lansdowne. Start maybe with Vanguard because they're very, very low cost. Start with Vanguard, and you need to kind of know what you're doing when you're picking things in Vanguard. That's the only thing. You can't ring them up and ask for guidance or anything like that. So you kind of need to know what you're looking for. I can help with that in coaching, but have a little ganders with them first. See if you're comfortable with it. Then you could pick something. If you're not 100% okay with the language, some of the terminology, what you're looking at in Vanguard, then the alternative to that, if you don't do coaching or something that I provide as a coaching package, you can go with the likes of Money Farm. They're really, really good because you can pick up the phone to them and you can ask questions and they can guide you around the selection criteria. But the main thing you need to bear in mind is when you go with someone like Money Farm or someone like that, then ultimately you're going to be paying them more fees. And Money Farm specifically is an actively managed fund, which actually isn't too bad when the markets are going a bit crazy. I mean, they've done very, very well for me. Really, really well for me. They've done double digits this year, even with all the volatility that we've seen, and they've taken advantage of that volatility as well. So, just somewhere for you to start from there. What other investment options are out there that you would recommend for recommend to beginner investors like me? Um, well, what do you mean? Are you talking about in terms of stocks specifically? Um, I mean, if you're a beginner, I definitely wouldn't recommend you start looking at things like trading and stuff. That's a different kettle of fish. That's a completely different ball game. Um, if you're a beginner investor, the important thing is to keep it as simple as you possibly can. Like it's a journey, right? It's like I use this analogy all the time. When you're a baby, you just don't get up and start running 100-meter sprint. Like you crawl, you find your feet, you stumble, you fall down, and then you get confident walking, then you start running. Same thing applies when you're investing. It's really, really important to take your time. Don't rush into anything. If you're going to start investing, by far the easiest way for you to get your feet underneath you and trying to, kind of get your training wheels off is to use things like, index funds and ETFs and use a core satellite approach. And, that's how I invest because it allows me, number one, not to have to look at my investments all the time and be worried what's going on and having to keep up with all the news when I'm busy doing other things. I can sleep at night. I can sleep way better at night, with a core satellite approach. And I've spoken about this before, and people often ask me what it is. And the way I normally explain it is a core satellite approach is basically this. You have the majority of your investment capital, okay, within, your index funds, your ETFs. So that will be your VUSAs, the S&P 500s, index funds, just in general, global, regional ones, whatever you decide to pick. And then around it, so this is your core right there. And then around it, what you then have is individual stocks. You might have Tesla. You might have Amazon. You might have Google, right? You might have the likes of Microsoft. You might have Facebook, which is now Meta, right? You then have these individual holdings, which are your satellite. And the idea here is you're going to dabble in these ones with little bits of cash, building up the capital in these. But the capital in these will never, ever, or should never exceed the capital that you have here. So let's just say in terms of numbers, you might have 70% of your capital in these core companies, these core index funds and ETFs right here, but you'll then have 30% distributed across all of these. And that's a core satellite approach. That is an easy way for you to start managing your investment positions and try to make sure that you're not overextending yourself from an investment point of view. Now, most people, they'll start with, going gun-ho with these first, which is fine if that's what you want to do. But guess what? There is a huge amount of risk if you're putting thousands and thousands and thousands of pounds in just a handful of companies and ignoring ETFs and index funds altogether. Each to their own, but if you're a beginner, I would definitely recommend looking at core, index funds, ETFs first, and then building your confidence with all of the companies around the periphery of the strategy. Hopefully that makes sense, mate. Is monthly pay in stocks and shares good for beginners? Which would you recommend? This is a really, really, really good question. And I talk about pound cost averaging or dollar cost averaging, and it is applicable to people who are investing on a monthly basis. And what I'm going to do is I'm actually going to illustrate this in a drawing because sometimes when I explain it, I'm not sure that people actually really grasp what we're talking about. So if you're paying in monthly, let's have a look at what the stock market typically looks like, right? Don't want that color. Let's go back out of that. Let's get black on. Right, so let's have a look at what's going on. 1 second, guys. There we go. Right, so let's have a look at the typical stock market, right? So let's just say this is your performance over the stock market. Yeah, this is your percentage returns here, and these are your years, right? So let's have a look at a 10-year period. Now, what you might find is that the markets will do this, right? But ultimately, they'll be trending up all the time. These graphs are common for anybody to know, right? And the idea is if you enter the markets here, where by the time you get here in 10 years' time, your money has grown and increased in value over that period of time that you're actually invested, right? That's the general theory of how investing actually works. Okay. Now, if you're pound cost averaging, I actually need that back. If you're pound cost averaging in every single month, right? What you're doing is you're basically buying units on a regular basis. So what you're doing is you're buying units here, you're buying units here, you're buying market here, 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 here. You get the point, right? You're buying markets on a regular basis. Sometimes you're going to be buying markets at a discount because the markets might be falling. Sometimes you're just buying it on the rise, okay? But the idea is that over the course of your investing period, because you've bought all of these little positions at these different points, when you get to your 10-year period here, the average of all the positions that you've bought basically smooths your investment journey. So some units would have done better than others, but it basically means that you as an investor, you don't have to worry about, okay, uh, I want to get into the markets, but I'm waiting for the bottom. And you don't know whether this is the bottom or you don't know whether this is the bottom because we don't know what's going on. The idea is because you're paying in on a monthly basis, you literally just continue to buy. And over the period of time, you're buying the units at different prices will basically mean that you'll have a really, really nice upward trajectory in terms of your investment returns. That's the whole premise and the whole point of pound cost averaging buying monthly. That's the benefit of it. You don't have to worry. You're just basically forming the habit. You're forming the habit, just buying your units, and you should then get a really, really nice, smoothed ride over your investment term. That's the whole point of pound cost averaging and how you invest. So if you are doing that, then by all means, just set up direct debit and just let the money go. Don't worry about it. Just catching up on myself. 1 second, guys. Okay. There's a conversation here. Manuel's just asking, how do we invest in index funds? Just go to any of the providers that I mentioned there. So Vanguard is a really, really good one. If you want to have a look at an alternative new one, and they can be a little bit cheaper than Vanguard sometimes because Vanguard charge a platform fee. They don't. Is Invest Engine. They are relatively new though, so just bear that in mind. But they are a really, really good company. I've done a review of them on the channel. So you can go and find that video. The video is called, well, if you look at the thumbnail, it's called actually cheaper than Vanguard. They did have a £50 offer on. It ended on the 31st of December, but I'm told that they're going to have a new offer coming out, I think in about a matter of weeks or so. So yeah, have a look at Vanguard, have a look at Invest Engine, have a look at Hargreaves Lansdown, have a look at some of those companies to get you started invested in index funds if you want to do it yourself. Otherwise, if you want help, you want people to actually manage it for you, then the likes of Money Farm, Wealthify, people like that will be really, really good for you. This is a mortgage question. So do mortgage providers typically charge extra fees for using a lifetime ISA? No, they don't. They're not actually allowed to, as far as I'm aware. So they shouldn't be charging any extra fees if you use a lifetime ISA. Even Bobo, how you doing? Happy New Year to you. So clarification there, food dwell. I mean, investing in property versus investing in stocks, index funds, ETFs. Which one is best option? It depends on the circumstance. It depends on your circumstances, mate, and what your goals are. Property is a good investment. Property has performed very, very well historically. I think it keeps pace with stocks. It's all about your position, though. So it's not a pure in property is better, index funds are better. It's all about your circumstances. Liquidity is often an issue with property, right? You can't just sell your property and get hold of cash immediately. The other thing that you have as a big concern with property is it's not very tax efficient. You don't have ISA allowances that you can invest into. You haven't got EISs that you can invest into, or SEISs. You haven't got venture capital trusts. You haven't got AIM markets that you can invest in for tax benefits alongside things like, your ISAs. Some of your investments can be outside of your estate for inheritance tax planning. That isn't always the case with property. Yes, you can get property outside of your estate for inheritance tax planning if you put it in a special purpose vehicle into a limited company, but that isn't right for everybody. You have to have a pretty sizable property portfolio for that actually to make sense by the time you consider all of the costs and the expertise in terms of accountants and all that you need in order to run and actually set that up. And obviously, the amount of time it takes for you to acquire that property, it takes years and years to get a portfolio where that is actually the case. So from a tax point of view and tax efficiency point of view, investing in stocks and in the markets is way more tax efficient than property, hands down. But that may not be the only driver for you. Based on your circumstances, you might say, actually, it's okay. I don't mind not being able to put money into an ISA, but I know that I've got this property which will appreciate in value. And you may have a strategy for property on its own. So it's not a clear cut. Property's better than index funds and stocks. It's not. It's all about your personal circumstances. They play their own role in different ways. So it depends on how it fits for you. Naeem, Pete, looking forward to your new content this year. My question is, any lessons you've learned from 2021 would you like to share? Anything as users, us users should be looking out for this year? Thanks. 2021, to be honest, mate, I don't think, the markets haven't really surprised me. Maybe crypto surprised me a little bit, but the markets haven't really surprised me, if I'm honest. I'm always conscious that this is an investment channel, so we talk about the stock market more than anything else. I've learned a lot last year just in business. I learned a lot last year just in business. I'm running my own business now, and you know, forging relationships and being consistent. And when things get really, really difficult, really, really tough, you have to kind of really look back and remind yourself why you started out in the first place. It's very, very easy when things don't feel as though they're going the right way to change tact. And I've stayed the course through last year. And through staying the course, a lot of good things have happened as a byproduct of that. Has it been hard? Yes, it's been really, really freaking hard. Has it been frustrating? Absolutely. It's been very, 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 very frustrating. Have I struggled? Most nights I haven't slept. I work stupid hours. People think that being an entrepreneur and running your own business is sexy, like leaving a 9 to 5 to chase your own dream. Well, you go from a 9 to 5 or a 9 to 9 to pretty much working, 18 hours a day. That's what I typically do. I do anywhere between 12 and probably 16 hours a day. It's a lot. I'm very, very tired a lot of the time. I'm a lot of run down a lot of the time. But I've learned a lot about myself. I've learned a lot about building a business in the way that I'm trying to do it here online. Those have been really where my lessons have been, not necessarily in the stock market per se, because with the stock market, I just know it's going to be unpredictable. So I expect it to be unpredictable. I don't expect it to do anything specifically or work in a particular way. I know that it's always going to throw a curveball. But I've learned a lot from a business point of view, and just really understanding your goals and setting goals from the outset. That for me has been massive. Like, looking back over 2021, a lot of the goals that I set, I achieved. Some of them I missed, and some of those things, even the ones that I missed, they weren't entirely within my control. They were very much like, if I could do that, that would be a cherry on top of the cake. The ones that I did achieve were the ones that were within my control. So it's all about setting those goals, being focused, being clear as to why those goals are really important, because you need that when you're knackered. When you're editing a video at like 3 o'clock in the morning, you've got to get up like 6 because you've got to get in the car and drive somewhere to go do something. In those moments, the reason why you're setting that goal becomes very, very important. And that's been the biggest lesson for me last year, more than anything else. I understood it when I was working in Canary Wharf and doing long hours there, but the reality I was employed by somebody. So I didn't have to work those hours, but I knew that if I didn't work those hours, I wouldn't earn the money that I was earning because it was down to me and the effort that I put in. This is a very, very different ball game. Like if I don't put in the hours, I'm self-employed. I don't make any money. Like I don't pay bills. And with the way YouTube works, it's not about, I mean, certainly for my channel, for people who are getting, 5,000, 10,000, 11, 20,000 views on each video, they will be able to pay their bills just from the AdSense. I can't pay my bills from the AdSense because my average video views is anywhere between 1,000 to 2,000 per video. I wish it were more, but the reality is I'm not making all of the hype investment type videos. I'm not doing that. So therefore it's not appealing. It's not sexy in that way. So I've had to find other ways to make the channel work so that I can actually pay my bills. So I've learned a lot in the business side of things and just self-regulation and self-management because at points last year it was very, very difficult. I felt like jacking it in and start to question whether you should just go back to a job where I could easily just walk into a very, very nicely paid job and not do this kind of stuff. But those are the lessons that I learned in 21, not necessarily investment related, but on personal development for sure. Thanks for asking the question. I have 100K in tobacco stocks in ISA, which gives me a great dividend every year, which I reinvest. I'm 54, looking to retire soon on the dividend, mate. That's awesome. I mean, once you get to, tobacco stocks, they do pay really, really well. There's some dividend stocks you can actually go and buy. I mean, AT&T is probably one of the highest ones. I think the last time I checked, they were doing like dividends of 7% and stuff. So you can do very, very well there. That's really good going, Timothy. Really good, mate. Cheers. Videos to view. How you doing? Good to see you here, mate. Thank you. Hi, Pete. Money Farm or Money Box? Which is better for managing inflation active versus simple index fund investment? I've got Money Farm, so I'm slightly biased. I would say Money Farm. They've done very, very well for me. When things were very, very volatile, they were rebalancing the portfolio, and I would get an email to say we've rebalanced and this is what we've done. For me, that provides a lot of comfort and a lot of confidence to know that someone's looking at it and I don't have to worry about it. So if I had to choose over Moneybox and Money Farm, I would choose Money Farm. And I think they are on par when it comes to charging. Actually, I think Moneybox more expensive than Money Farm. I could be wrong. That's just me just trying to work it off just off memory of being with Money Farm as well. But I would choose Money Farm for sure. Aha, Jeff. Yeah, your mid-20s, was looking at just from a pension point of view. Spoke with you about a year ago now, but a while back. Going well so far. The advice you gave us, thank you, mate. I really do appreciate it. Yeah, so look, if you're in your 20s, mate, obviously the pension, 55 years old. So it's if you know that you're not going to need the money, and I think from memory, you've got house purchase on the horizon for you, and if that is still the case, then you maybe want to be looking at ISAs, lifetime ISAs, because at least you can accumulate money in those accounts, but use it towards a deposit if you needed to. Whereas you lock it into a pension, it's 55, which is a long way away from you at the moment. So as long as you're making contributions into your pension right now, that's the most important thing, because at least you're building for the future. But you've got to bear in mind, if you've got other goals like house purchasing, you need to do those two things in tandem. And the most important one that takes precedent is your closest goal on the timeline. Oh, mate, listen, Carl. Mate, if I could recommend a provider that has really, really good rates right now, I would. I mean, the rates are really, really shocking right now. I mean, one thing that you could do, you could put money into things like NSI premium bonds. I can't remember what they're paying in terms of interest right now, but at least you get entered potentially into a draw each week. So you could win, I don't know, 25 quid, 75 quid. I think their top prize draw is like £1 million. So that alongside the basic interest thing that they give you and the prize draw, I think that's probably better than what you're going to get on most high streets. But yeah, savings rate at the moment are just absolutely shocking. It's really, 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 really bad. I'm just conscious of time. I think I'm going to give it maybe another maybe another 15 minutes or so because we're an hour 12 minutes in right now. So I'm going to see if I can get to some other questions and then we call it a night. But I'll be here again next Sunday. So let's see what we've got here. Pascal. Um, actually, let me go to Pascal first, Owen. I'll come back to you. Happy New Year. I hope you're well. Thanks for this session. Please, is it advisable to sign up to employers' 3 to 5 year share save scheme? Many thanks. Yes, if they're a really, really good business and they are doing really, really well, and the share price, the business is solid, by all means, you want to start acquiring those shares. Absolutely. I've worked for companies in the past where I didn't do that, and I really do regret not doing it. RBS was one of them, where we would get discounts on the shares, and that's what happens a lot of the time. If you sign up, you'll get a discount on the actual share price. So if you can, definitely sign up to it, mate. Owen, I have a question about currency and the S&P 500. As a UK investor, is invested in something like the SPS1 or the VUAG worth it? What's the CSP1? What is the CSP1? I'm not familiar with that one, mate. Let me see if I can find it. Okay, so this is the iShares Core S&P 500, right? Okay, so what's the currency question then? Are you asking the question of the fact that you're buying it in dollars and you've got the conversion rate or the foreign exchange impact? Is that what you're asking? Can you clarify that for me, please, mate? I mean, look, the way I view, if you're buying like an S&P 500 and you've got to buy it in dollars and not pounds, like if you can't find a GBP equivalent, then you just do it. It's like you can't. I mean, well, people do. People do say, I'm not going to invest in something because you've got the currency conversion. I mean, I just think that's like stupid, if I'm honest, because it's like you're cutting off your nose to spite your face. So what you're essentially doing is you're saying, if this is the question, is you're saying I won't invest in a fund because I've got the currency conversion into pounds, and the currency rate might actually hurt me in the future and reduce my returns. Well, as long as you get a return, what does it matter whether the exchange rate is negative or positive and works in your favor or not? It's just the cost of doing business. So I don't think it should be a problem. It shouldn't be something that should deter you if you're worried about buying something in dollars and you've got to do the exchange rate. That's just the way. That's just how investing works, mate. And just put it down to cost. You want to get access to this market. You want to get access to that fund. You've got to buy it in dollars. You've got to do the conversion rate. You've got to pay a fee. You've got to, deal with the exchange rate conversion. It's the cost of doing business. You want access to that market or that fund for growth purposes. As long as you get that growth, it doesn't really matter. Yeah, you're going to might have to pay 20 quid or whatever it might be, or depending on how much you have invested, but it's the cost of doing business. What apps would I recommend? So apps, I mean, Vanguard don't have an app. It's desktop based only. They won't build an app. They're just stubborn like that. They're old school. Money Farmer's got an app. Hargreaves Lansdown has got an app. You can get ETFs, index funds in free trade. The only thing I don't like about free trade is they put a lot of the good ones behind a paywall. So you've got to then pay $9.99 to get access to the full kind of like suite, which it's fine. That's their business model. But I just think it's a bit, yeah. If you're looking at US specific specialist or US ETF specifically, then people like Stake are a good one as well. Yeah, just a few right there, mate. Oh, this is good. Okay. Taking a private pension in February, I'm going to invest 25% of the lump sum, which is tax free. Looking to buy more S&P 500. Mm, mm. Before you do that, mate, and this like at the danger, you've already taken it, haven't you? You've taken it. Mm. I mean, this will get a little bit technical, but I'm going to go through this explanation anyway because I think it might actually help people. It is highly technical though. So the reason why I kind of like went there was because within obviously your pension. So let's just keep the numbers simple, right? If within your pension pot you accumulated £100,000, yeah, you know that you can take a quarter tax free. Okay, so this is essentially what you've done. You've taken 25k tax free. You're now going to take this 25k and you're going to go put it into S&P 500. Yeah. Now, did you say you're going to put that into an ISA? Yeah. So you're going to go put this into an ISA, which is fine. Still tax free. It may seem as though no harm is done here, but I would argue that actually maybe there is a little bit of harm done here. Purely because, and granted, you don't know whether your pension fund had any S&P 500 exposure. Granted, you don't know that. And granted, you may or may not be able to pick your investment specifically within your pension fund. But here's where I feel as though it's worthwhile thinking about these choices before they're being made. And you've already made it now, but this is just for everybody else who's kind of like who might be looking at this kind of stuff and watch this video, on repeat. Whilst your money is in your pension wrapper here, because this, by the way, was your pension or is a pension, yeah. Your tax-free cash, yeah, your tax-free cash is on the value. Try and get the colors right here. Is on the value of the contents of this pension. In other words, if you kept it invested here, and let's just say this increased to £150,000, and you just kept it invested and it kept growing, right? And let's say you end up with £150,000. Now you're looking at 25% of £150,000, which actually gives you a greater amount than 25k. And I know that's it's a little bit technical, but as a financial advisor, when we're advising people and people say to us, oh, we want to take out our tax-free cash, we're asking why. We're asking, why do you want to take it? And do you have to take it? And if in this instance you were saying you were going to take it to go and invest in something else, we would probably run you through this to say, listen, you need to think about it properly. Because if you didn't need this £25,000 immediately to go and put in here, then potentially you could have had more growth that you could have got, potentially, and a higher amount of tax-free cash by simply leaving it in there. It's all said and done now, so it doesn't really matter, but it's just a thought. And I don't know whether you have any of the other pension funds or pension pots that you haven't taken, but this is a really, really important consideration for people when they're looking at pensions and taking tax-free cash. Really, really important consideration, because and the flip side to this is, and this is where you've got to look at both sides. So let me just not paint a rosy picture. Let's just say this went down to 75k because the markets were very, very turbulent, which, by the way, it could happen here anyway. You're still going to get 25% of 75k. So that's giving you both sides. That's giving you the flip side of it all. But in an up market, there's more positive gain to be had, potentially. Anyway, good conversation going on here. Oh, this is a really good question. Okay, cool. So I am going to answer this one. I'm going to answer this question. I'm going to maybe take one more afterwards, and then we're going to call it a night. So how profitable would you say NFTs are, Pete? I think NFTs can be very, very profitable. I mean, the NFT space seems to be freaking just going nuts right now. However, like if you're buying individual stocks, so you're going into crypto, and this is a really, really sad thing. Like, obviously, I did the live stream on Tuesday about the Bored Bunny NFTs, and there's still a lot of confusion as to what's going on there. I don't know whether people have fully got their mints or not. But what seems to happen, and this is happening with all of the projects, is, and I've noticed this with Hate Beasts and Dronies, that I'm also in their groups as well. You're going to have people in there posing to be the legitimate project. website looks exactly the same. And when you go and mint something, you connect your wallet, you go and mint, you're minting to a scam website, which delivers you nothing at the end of the day. And I think this is where the trouble basically lies. There are so many projects being launched right now with the promise of these things will 2x, 3x, 4x, 5x. I mean, there are just shed load of videos here on YouTube. You have to do your research. You really, really have to do your research, and you have to have your wits about you. I had a message on Instagram, literally. Actually, no, he emailed me. Let me just find this email. And it was around the Bored Bunnies NFT mint. So he went to, let me just find it. What website did he go to? And it breaks my heart to get these kind of like emails. But they asked me, what can I do? And it's like, there's nothing you can do. Like, bearing in mind that, these guys are anonymous. They're on the internet. They're somewhere in the world. So he basically said, thanks for the, no, that was my response to him. Where's the email? He goes, apologies to reach out, but I'm hoping I can have some advice, please. I fell for the scam, and basically he went to the website called mintboardbunny.net. Now, I'm sure these lot would have been in the Bored Bunnies Discord group and would have been messaging people and would have had a site up which looked identical to the legitimate site. Instead of the actual site, he put in brackets here. He goes, I sent quite a bit of money to that scam account trying to mint bunnies. I had just started out with NFTs and feel like such a fool and very upset since it was a lot of money to me. This happens all the time. So it can be very, very profitable, but you need to be very mindful of the cowboys that are out there. And ultimately, this is the truth. A lot of the projects that are being minted right now, they are all going to go, there'll be a large majority of them will go to zero. So which means that you've got to do your research even further. I personally think that the ones that will do well the most, well, who do the best, will be ones who, number one, have a really, really strong community. Really, really strong community. Maybe they have a brand or some kind of I don't know, culture following behind it, right? The way I think about this is to think about, I don't know, the Disney NFTs that were minted, where you had what's the name of the guy who created Disney, Walt Disney himself, holding hands with Mickey Mouse. That NFT is worth a shed load of money. There was only one of them minted. I think those projects would do well. But if you're looking at just general projects that are being launched, you need to be very, very careful. Not to say that they won't be profitable. They will be, but you just need to be careful, because even in the Discord groups that I'm part of at the moment, because I'm looking at a couple of projects, it's very, very hard for even me to decipher which one of these accounts and these websites are actually legit, because they look so convincing. It's so easy to fall for these things. So you have to do your homework. You really, really do. Well, let's take one more. Yeah, man. I like this. Never worked as many hours per week since I stepped off the corporate ladder back in May 21. Wow, dude. Yeah, so you did it recently. Yeah, it's hard, man. It's an adjustment. It really, really is. It's a massive, massive adjustment. I will tell you this, though. It does get easier. Well, easier is probably the wrong word to use. It gets more manageable. It gets, you can cope with it more and more as you get into it. Yeah, it gets a lot more manageable is the right word to use. I'll take one more. Yeah, Owen, I saw that as well. Cheers, mate. Thanks. Oh, it's a DB pension. Wow. Dude, you hit the jackpot, mate. Those things are like gold dust, man. Like gold dust. Yeah. So don't worry about that. Yeah. So that equation, you won't need to worry about the whole tax-free cash on a whole DB thing. I mean, you will get an element of it in some of the things, but it's all good. My battery's going to run out. Oh, I think that might be a sign, guys. So maybe not one other question. But anyway, thank you so much for watching this. Have a good evening this evening. Have a great week. I've got a video coming on Tuesday, and then some other bits and pieces during the week. But guys, thank you so much for joining me. Have an amazing week. Catch you later on.